Analyzing accounts receivable. Firstly, an accounts receivable is an amount owed by a customer who has purchased a company's product or service. It is important that a company analyze their accounts receivables, as any investor, creditor, or manager of a company should be interested in how well a company manages its accounts receivables. The main question that should be asked of a company is how well it collects its receivables. Now let's move on to the methods used to analyze accounts receivables. The first method is horizontal analysis. It is a method of analyzing a company's account balances over time, and it is calculated by minusing prior balance from current balance and dividing that from prior balance. For example, on December 31st, 2019, company XYZ recorded an accounts receivable total of $2,378, and on December 31st, 2018, the accounts receivable total was $1,163. Plugging that into the formula, we get 1.04. This means that accounts receivable increased by 1.04%. Next is vertical analysis. It is a method of comparing a company's account balance within 1 year as a percentage, and it is calculated by dividing accounts balance over total assets. On December 31st, 2019, company XYZ recorded accounts receivable at $2,378 and total assets at $39,117. Plugging that into the formula, we can see that accounts receivables is only 6% of company XYZ's total assets. Next is receivables turnover ratio. It indicates how many times during a period a company generates and collects receivables. Generally, a higher ratio is better, and the formula is credit sales over average receivables. On January 1st, receivables was $908. On December 31st, receivables was $2,378, and credit sales was $5,000. Plugging that into the formula, company XYZ generated and collected its receivables balance over 3 times in 2019. However, companies prefer to use days in receivables. Days in receivables expresses a company's ability to generate and collect receivables in days. The formula is 365 divided by the receivables turnover ratio. Plugging that into the formula, it takes about 120 days between selling an item and collecting the receivable. Finally, the allowance ratio. It measures the percentage of receivables that are expected to be uncollected in the future and is generally wanted to be as low as possible. The formula is average for doubtful debts divided by gross receivables. On December 31st, 2019, allowance for doubtful debts was $6,000, net accounts receivable was $10,000, and average for doubtful debts was $2,440. Plugging that into the formula, we get that 15% of company XYZ's accounts receivables are expected to be uncollectible. And that's analyzing accounts receivable in less than 3 minutes.